Something's looking better, baby. Just passing through. And I think it's gonna be a long, long time till touchdown brings me round again to find I'm not the man they think I am at home. Oh, no, no, no. And this is what it's gonna be.
Right from the start, I saw you looking round the room. The kind of freak that needs a freak show's gonna find one soon. I looked at you, you looked at me, and I knew right away that it was wrong, but we were gonna do it anyway. Yeah, you crazy girl. Yeah, you got something that keeps me coming back. You know it feels so good to me. You crazy girl. One of these days you'll be the enemy. Because I just can't help myself. Mama told me, Papa told me, Grandma told me too. Them crazy girls know where it's at, but don't you be a fool. Cause once you get a taste, your dumb boy ain't no turning around. Don't you think I know all about what crazy girls are putting down? Yeah, you crazy girl. Yeah, you got something that keeps me coming back. You know it feels so good to me. You crazy girl. One of these days you'll be the enemy. Because I just can't help myself. You crazy girl.
Please take your seats. The program will begin in 5 minutes.
Tell you to run on the way. Nobody say, nobody on. Well, pick me up with golden hand. On me say, on me tell you to run on the way. Nobody say, nobody on. Well, I would like to hold my little hand. How we will cry, how we will cry. I would like to hold my little hand. How we will cry, how we will cry. Send me in my way, 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 send me in my way. Out my hand, oh me sail, oh me tell you to run on the way, nobody say, nobody else.
Please take your seats. The program is about to begin. Please take your seats. The program is about to begin.
Yeah, you can just put in the back of the room.
Peace of mind, a friend of mine. Whoa, 16, 12. That's close to my heart. I go 1, 6, 1, 2, oh, star. I go 16, 12. It's close to my heart. 1, 6, 1, 2, ooh, star. I go 16, 12. It's a close to my heart. I go 1, 6, 1, 6, 1, 6, 1, 6, 1.
Please take your seats. The program is about to begin.
12 is a good in my heart. I go 1, 6, 1, 6, 1, 6, 1, 6, 1, 6, 1, 6. I go 16, 12 is good in my heart. I go 1, 6, 1, 2. Hey, hey, hey. I go 12 is the key, is the key, is the key, is the key, yeah. 12 is close to my heart. You never, ever get it. You never, ever get it. Never, ever get it. Never.
Please take your seats. The program is about to begin. Please welcome to the stage Bloomberg's Janet Wu.
Good morning, everyone. It is so great to see you. And welcome to Bloomberg Invest, Recessions, Recoveries, and Opportunities in Between. We are so delighted to have you join us in person here in New York and also virtually from all over the world. We are going to kick off some important conversations around the financial markets and the economy. And all of you early birds get breakfast and some extra information. As you know, amid high inflation, geopolitical uncertainty, and growing scrutiny in the banking system, volatility has hit so many aspects of the financial markets. And as threats of a recession loom, investors are struggling to position their portfolios for long-term growth and returns. With that, we have gathered some seasoned strategists and expert market watchers. They will share their outlooks on different asset classes and how they are managing risk. Before we get started, just a few announcements. We would like to acknowledge our sponsor for these sessions and your breakfast, Allspring Global Investments. For those of you here in the room today, we do hope you enjoy your breakfast. Do continue eating and enjoying your coffee. And you can find your Wi-Fi information on your badges. For our virtual attendees, if you experience any problems with your audio or video, just try the old-fashioned thing first. Just refresh your browser. You can also use the chat box on the bottom right-hand corner of your screen for support. Please engage with us on social media because a lot of people are watching this virtually. You can use the hashtag BloombergInvest, and you can also watch highlights from the entire event over these 2 days by following at Bloomberg Live on all social media platforms, Twitter, LinkedIn, and Instagram. If you have a Bloomberg terminal, just use the function Live Go. Now, let's get started with a very warm welcome for our first panel. Art Hogan, Chief Market Strategist, B. Riley, Wealth Management, Winnie Caesar, Global Head of Strategy at Credit Sites, and Alyssa Rusinoff, Head of Credit, Crescendo Asset Management. Thank you so much for joining us today. Winnie, let's begin with you because we want to hear a little bit more about your job. Your firm offers independent credit research and analysis. Tell us a little bit about your day-to-day role now and how much more complicated it has become.
So my day-to-day has become more complicated. It feels like forecasting is a bit of a fool's errand, which is probably something I shouldn't say as a strategist. But it's also a lot more fun because we get to think in frameworks. We get to think about different places that we've never gone before. Again, fixed income and credit look interesting with valuations where they are. And so the day-to-day is really just trying to play this massive game of whack-a-mole and trying to figure out, okay, what do we need to focus on next? Do we need to pivot? Where is the next opportunity? Is another round of volatility coming? It's become very challenging, but also a lot of fun.
And we're going to ask you about some of those pivots in a little bit. Alyssa, how much does Crescendo have under management? And tell us about your particular focus on finance strategy.
Sure. So Crescendo Group is a Geneva-based wealth manager with over $3 billion in the management. And in addition to asset and wealth management, we have several funds, including private debt, consumer finance, VC, and trade finance fund that I'm running.
Art, you are just back from the West Coast. You held your institutional investment conference in Beverly Hills just last week. Can you briefly tell us some of the big takeaways you got from that summit?
Yeah, so this is the 23rd annual conference we've had out there in Beverly Hills. And Beverly Hills is certainly not like New York City or Boston for sure. So there was a lot of glitz and glamour around that, which was kind of interesting to see, which I was probably a little too starstruck. And everyone else thinks it's normal to see somebody famous. I would say that of the 200 companies we had presenting, which was about 185 publics and 15 privates, everyone to a person was relatively optimistic about the future. I think they've gotten to a place where they've right-sized both real estate and number of employees, which I think is important, and felt like that there wasn't going to be more of that. And actually, we heard a lot about an increase in CapEx over the course of the next 3 quarters. So I thought the takeaway was pretty positive. It's a lot more positive than it feels right now in the narrative.
You were there and you saw a lot of your clients face to face. So you say that you saw a lot of positivity. What are some of the bigger concerns they are expressing to you?
You know, it's interesting. So to a person, there's always some disaster du jour that they want to help, that needs to be sorted out. And that can be anywhere around the fact that this recession seems to be like waiting for Godot. Yeah. It's been around the corner for 18 months, and why hasn't it happened yet? And just kind of helping to sort of break down some of the confirmation bias that sits within that. You know, we've always had a recession when the yield curve inverts. Well, that's not actually true. We've had a lot of we've never had a recession without one, but we've also had inverted yield curves without having recessions. And what we haven't had necessarily is a recession with unemployment below 5% for as long as we've seen this, and sort of talking through some of the, you don't always have to say this has to happen, and I think that helps with a lot of the sort of assumptions that investors are making that the sky might be falling, when in actuality you might miss a lot of opportunities.
We're talking about the difficulty of forecasting now because, as you mentioned, there's a lot of mixed signals, and even the positive ones make things more complicated. Winnie, you were formerly head of credit strategy for Wells Fargo. Can you share how that experience in consumer banking is impacting your forecasting now and the lessons that you learned from that to your job now?
Yeah, absolutely. I think that we're all very focused on what is the consumer doing, how much excess cash is still in the system. There's a massive dislocation between consumer sentiment, which is quite negative, and consumer spending and the employment market, which is still very strong. So trying to understand the motivation and psychology behind the consumer, as it is the biggest growth engine in the US economy, kind of lifts up the global economy as well, has been massively important this year, and we work very closely with all of our consumer-focused analysts at credit sites to try and get it right.
Alyssa, who are your clients? Typically who they are and the size that they have invested.
Sure. So when I say clients, I have two sides. So my clients are my borrowers, which is SMB world, small to mid-sized businesses, and my clients are investors. And as a Geneva-based company, we have a lot of relationships in the European Union, in the UK, in the Middle East, in South America, and I'm certainly seeing a lot of sentiment in terms of more interest towards US or UK or generally European Union investments, and that has been changing in the last, even with South American clients, which has been, regionally and historically a little bit different. Countries like Chile and Brazil, there's a lot of interest in terms of US economy, and as I mentioned, I'm working with a lot of SMBs, small to mid-sized businesses, or SMEs, some people call them, and that, I think, is a very interesting niche in private debt. It's a B2B type of lending or non-bank lending. And we have to realize that SMBs actually account for 44% of GDP in the United States. And they're way underserved in the United States and globally as well. And it's a multi-trillion-dollar business, and I'm talking about trade finance, which really includes several topics. It's supply chain finance, it's account receivable financing, it's asset-based lending, and I'm also focusing on something that's called embedded finance, which really means through open API structures and what's called webhooks, there are various types of offerings by non-financial services or platforms in terms of financing. So that's a very interesting tool that a lot of companies are just trying to understand right now, because it's a great opportunity. It could be B2B, it could be B2C, but it's a tremendous opportunity for the market.
I want to ask you a little bit more about each of those specific things. Let's talk about the supply chain finance, because that was the global headache, especially painful here in the U.S. during the pandemic. I know we've learned some lessons. The ship has been righted in many ways, but this is also creating a financial opportunity for growth. Talk about that supply chain finance.
Absolutely. When the markets are not doing well, non-bank lending business is actually doing well, and I'm sorry to say that, but I'm in a good economy in terms of my business. So basically, supply chain finance, and you're absolutely right, supply chain constraints, they really led to a lot of changes in the world. Globally, we're talking about deglobalization, we're talking about pivoting towards other markets, towards other vendors, suppliers. A lot of my clients are actually moving their manufacturing facilities to Latin America. A lot of it goes to Mexico, a lot of it goes to other countries in the region, South America as well, and Mexico obviously as part of it. So that has been changing, and the fact that the small businesses are being constrained in terms of their working capital obviously gave us a tremendous opportunity in terms of financing, because we know these customers are getting paid, but the invoice terms are really expanding, and they have to pay their suppliers on the other side to their vendors in a very short order as well. So they have this gap in terms of working capital. That really helps our investors, and they absolutely love it because it's a short-term liquidity, right? We're providing capital which really cycles all the time, and that capital could cycle anywhere from 15 days to 120 days, and you just repeat that all the time, right? If you think about the company, they're selling some products, some services, and it doesn't really matter what their business model is, but they're constantly selling, which means they constantly need working capital for their OPEX. So it's been a tremendous opportunity. Right now I'm seeing that a lot of supply chain that has been broken is being repaired or has been repaired. So obviously it helps with working capital, it helps the SMB world, helps the trade, and at the end of the day helps the consumer, which is important.
Art, tell us a little bit more about your clients at B. Riley, and along with that, you spent 30 years concentrating on equities. Are you also finding that your clients are looking for more diversity in their portfolio for these things that we were not discussing 30 years ago, like supply chain finance? Yeah,
there's all sorts of new things that are opening up. So the short answer to who our clients are, I think, is complicated, right? So we're an investment bank. We focus largely on small and mid-cap companies on that side of things. And away from that, our investors are twofold. So we have institutional investors that are interested in small and medium-cap companies. In large part, that's what we research. The 400 names that we cover are largely, not Google and not Apple. Away from that, we have a asset manager or wealth management division that has about $35 billion in asset under management. So that's thousands and thousands of regular folks at home trying to figure out what they should do for their retirements. So in a sense, all of that has evolved over the course of the last 30 years. I don't think that any of us thought that we'd need to be experts in the massive complexity of investment opportunities there are right now. And at the end of the day, our job really is to try to simplify that as much as we can, try to package together opportunities. So for example, 25 or 30 years ago, if you had a 60-40 portfolio, that was pretty straightforward, right? And there was no sort of, and we should also have some alternatives in here, or how do we actually approach precious metals and those types of things. So the good news is, as an industry, we've gotten a lot better at packaging those things. What we need to do is get a lot better at explaining those things and educating the investor as to why it is that you need that. Because there's a lot of things that investors will hear about that perhaps they should kind of stay away from, because there's been some dangerous things that have been created over the course of the last couple of years that probably need to be avoided.
Okay, so let's go beyond the last couple of years, because you have a long career that you have seen the ups and downs. We talked about recessions, recoveries, and the opportunities. Can you share with us some of the lessons that you have personally learned managing money over all of this time that you can share with investors right now that are basically buckling up and nervous?
Yeah, I would tell you this. I think that the one thing that has always rung true is that investors tend to lose a lot more money and certainly a lot more sleep preparing for a disaster. And there's always something on the horizon that is going to tip over the apple cart. And we can invent problems virtually every day. Geopolitical uncertainty. Well, there's always been that, right? And there's the fact that we're likely going to see a global economic slowdown. But that happens. We're in a cyclical business. I think that over-preparing and not focusing on long-term has been probably the biggest mistake individual investors make. As a matter of fact, you'd be surprised at how many people waited for 10 years to get back in the stock market after the great financial crisis because they thought we're going to go into some sort of double-dip recession. I don't remember how many times we talked about that. So the same thing is true now. We've got that sort of confirmation bias, or that recency bias that there's something bad that's going to happen, and I please don't take this the wrong way, but a lot of folks in the media, not you of course, will play into that because if it bleeds, it leads, and bad news is intriguing to folks, and we have a natural human instinct to be fearful of the unknown.
So let's be hopeful. Let's talk about recoveries. Winnie, something that you and I discussed, so interesting, that when we look at different asset classes, you have to realize that each class will have a different timeline. Say the tech dips in recovery versus what we're seeing in transportation. Can you briefly discuss that?
Yeah, I think that this speaks to the rolling recession narrative that we're seeing a lot. And I'm not a big fan of using the word recession. There's a very specific definition, associated recession. But contractions and cyclicality, I think, is much more appropriate. And if you talk to anyone working in the tech sector over the past 12 months, they'll tell you we were in a recession. That felt really painful. And also, the U.S. economy continued to trundle along quite nicely. So identifying these places that have already been through it and realizing that we're perhaps not going to stay in the mud forever, and then saying, okay, well, what's next? Transportation, now seeing a big shift in terms of the deglobalization, or I think the globalization diversification patterns that we're seeing away from West Coast ports toward East Coast ports. There's just a lot of very nuanced moving pieces that you have to have a really good handle on.
So we are actually down to our last few minutes in this conversation, but the beauty of this summit is that you can approach people in person and ask them questions. But for my last question to you all, I want to put you a little bit on the spot. I want to just have you share what you see coming in the next 6 to 12 months. You can say we're going to be in a recession, we're going to be in a shallow one, or you see things going full steam ahead. And also what you think is going to become most interesting as far as where to invest, what kind of class. So Art, we'll start with you.
Terrific. Well, I would tell you this, and I love the way you talked about rolling recessions or rolling contractions, and we've gone through that. I think the important thing is, in this economy, just seems to refuse to go gently into the good night, right? And I think that's going to continue.
That
to
is
be
poetic, Art. That makes anything sound just much easier.
I would tell you this. What's happening right now is we over-indexed our goods consumption and under-indexed our service consumption for 2 years, pulled forward a lot of demand in goods. That obviously caused a lot of disruptions, supply chain issues, and it gave us too much stuff. So now we're just consuming services, but that's going to slow down too. And I think both are going to mean revert back up to expansion line. I think manufacturing is getting there and plateauing. I think services will cool off enough, but stay above expansion line. And I think there's more good news than bad news in front of us.
Okay.
I'm going to try to touch on my favorite topic, which is a little bit of tech. So I see tremendous interest in private debt, B2B, SMB world, trade market, trade industry in general. But what I do think is going to drive that is the technology. And what I've built internally in the company and my prior experience in the fintech, and it helps that as well. Open banking, generative AI, integrations with the client's ERP systems. Trade finance has been always historically kind of not necessarily an attractive investment because people don't understand what it is. People don't understand because of its complexity, structural differences, and lack of data, lack of information. But when you actually integrate it with the client's bank accounts via open banking systems, through their ERP systems, through what's called electronic invoicing systems when talking about international trade. When we're getting data from so many different sources like the customs, the shipping data, et cetera, you actually build the tool that helps you mitigate the fraud risk, which is a tremendous risk in my industry. So I'm seeing credit risk, I'm seeing operational risk, and I'm seeing fraud risk kind of shrink due to this technology innovation. And I do see the trade finance or private debt industry really exploding because of that.
Okay, so within technology, because you said that's what's going to drive us back, clarify what you think is the most compelling area within technology. Is it fintech or is it AI, or do you want to say both about equally?
Well, I think they're not mutually exclusive, right? You can use AI, and a lot of companies that I know or partner with or work with, they use generative AI to really help them in their fintech business. But I think fintech and embedded finance as a product that doesn't necessarily require you to go elsewhere for financing, but it's really part of the tool, which is a non-financing platform. I think that's going to drive a lot of business.
Okay, Winnie, I do not have any discomfort asking you for your insights because you are a global strategist. So what do you see coming in the next 6 to 12 months?
So we're pretty constructive. We've had a contrarian call calling for tighter spreads in the credit market really for the last 8 months, and it's really run its course pretty nicely. We are still preferring credit risk over duration risk. We think that long-end treasury yields have a little bit more to go in terms of moving higher. And if you just look at the U.S. high yield market, single Bs trading in the 8 to 9% range at the front end of the curve, that feels like a really great opportunity.
All right, thank you. I am sad we have run out of time. Thank you so much for sharing your insights, and they will be sticking around the conference, so you can definitely catch stairs. Thank you so much. And our sponsor, Allspring Global Investments, for this breakfast. I would like to welcome now Head of Active Equity and Chief Diversity Officer, Ann Milletti.
So if you haven't heard of Allspring Global Investments, it may be because we're new in many ways. We are an asset manager that was part of a large bank until 18 months ago when we gained our independence. But we're not a boutique. We are a global firm with 23 offices across the world, more than 1,400 associates, and nearly $500 billion of assets under management. And I'm lucky enough to run our active equity business. I'm really happy to be part of Bloomberg Invest here with you today. Our mission at Allspring is to elevate investing to be worth more. And to me, the mission is really personal. I needed investment support well before I stumbled onto a career in investment management. First, to help my family get out of medical debt. My husband and I encountered, even though we had medical insurance early in our lives. And then we needed help to invest in a college fund for our kids, and then to save for a home, and then for retirement. In fact, it makes me think I should probably check and see how that retirement fund is doing. And when I speak to our clients, whether they're retail or institutional, it is clear that they all have very personal needs as well. And while our conversations always center around potential returns, They also have other concerns and goals that they want to achieve as well. And very often we find that we can help address those as long as they're willing to place their trust in us. And while I don't have time to meet with each of you today to see how we can help elevate your investing to be worth more, I hope I can leave you with a small thought, something that has helped me in my personal life, but it's really translated to helping me to be more successful in my career as well. It's a lesson that I learned early in my adult life. A little more than 30 years ago, my husband and I were blessed with our first child, a son. He was a beautiful baby, 10 fingers, 10 toes, perfect on the outside. But the happiest day of our lives was quickly turned upside down when the doctors suspected he wasn't perfect on the inside. They thought he probably had a severe heart condition, one that was life-threatening and needed immediate surgery. And it turns out they were right. He had open heart surgery when he was just 4 days old and spent the next several months in the hospital. The day he was discharged from the ICU to us, they took him off all the machines and the monitors, and they handed him over to us with no monitors and sent him home. We had all the fears that any first-time parent would have. In addition to that, we worried, how were we as new parents, first-time parents, supposed to know how would we know when something was wrong, when the very medical professionals that were taking care of him needed these monitors to know when something was wrong? But he survived, we all survived, by learning how to listen for the quiet. Obviously, infants can't tell you when there's something wrong. But to make it harder, heart patients, especially children, tend to have quiet symptoms. They aren't typically fussy when there's a problem. There's no fever. But there are quiet signs when things aren't right. The challenge is that you really need to learn to pay attention to the little things that most people would ignore. At the time we had our son, I was also an elementary school teacher. So this made some sense to me. I often encountered kids who struggled with something, but they often couldn't or wouldn't tell you what was wrong. But if I paid attention and really listened for the quiet, I could often figure it out. When I entered the world of asset management, I had a lot to learn, more than most. But the lesson that I learned, listening for the quiet, became my superpower. Instead of always being focused on what everyone else liked, I looked for what they might like next. When there was a lot of fear centered around something, I forced myself to consider what might already be priced into the market and start to think about what I might be worried about or what they might be worried about next. The lesson continued to serve me well as a portfolio manager. When we met with our companies and our management teams and we focused on their companies and their strategies and even their financials, I learned to consider and think about the things that they weren't saying to us just as much as the things that they were. In my role today, I continue to ask our investment professionals, what are the most interesting things they are seeing and hearing that no one else is talking about? When they listen for the quiet, what are they hearing? Their answers are the things that I continue to share with our clients. If we are successful at Allspring, we're also listening for the quiet with our clients. We have the expertise to look around the corner, to talk with them, not just about the hot topics or the hot products, but to dig deeper, to anticipate what they might need tomorrow. Because of our unique positioning, being a global asset manager at scale, but small enough to be flexible, we can provide a personalized client experience and give direct access to our senior leaders and our investment professionals. This type of client engagement is important not only to meeting our clients' needs, it's essential for our future success. Now, the markets are tricky. They like to encourage groupthink because it's the easiest way to create pain when things turn in a different direction. Work hard at keeping an open mind Think about things that could create a different narrative than the ones you're hearing in the crowds today. I'm sure you're going to hear a lot of those things today. I hope I get a chance to meet with each of you in the coming months or years. But until then, I will continue to work with our investment teams and listen for the quiet. And I hope I can continue to elevate the investing experience to be worth more at Allspring. Thanks so much.
Thank you so much, Anne, and thank you for reminding us to pay attention and to listen to the quiet and also look for lessons and opportunities where other people are not looking. What can the last 20 years tell us about the next 20 years of investing? What has changed? What has remained the same? Let's discuss how all generations, including young investors who don't have the experience of pain, how we can all prepare. Please welcome Sherry Paul, Senior Portfolio Managing Director with Morgan Stanley Private Wealth Management. I just have to point out that we were at a dinner last night for Bloomberg New Voices, where we are amplifying more women in finance on our different platforms. And I said, Sherry, today we are going to have diversity in height. Thank goodness we are sitting down. But she is a powerhouse, and I've had so much fun learning from you and getting your insights that we can share today. So I first want to give people an idea of what you do. Morgan Stanley, of course, we do not, you don't need to explain that, but tell us about your clients. You deal with high net worth portfolios and clients. What does high net worth mean?
Well, it's great to be here with this, incredible group of peers talking about the markets and what we do and its impact. Within private wealth, so my team, the Sherry Paul Group, we sit within private wealth at Morgan Stanley. And within private wealth, I'm also a senior portfolio manager. And so essentially what we do for our clients is holistic financial and life planning, and then custom built portfolios that sort of deliver on that personal money mission within the family. And one thing I'll just note is that our specialty on our team are first generation wealth creators, which has been such an incredible privilege to learn all the different ways that people build and construct wealth, but also how on the back end, how disruptive that is to identity and purpose and family trees. And so a lot of the work that we do also is consulting on, the soul power of what's the point of the money, which is really where drafting the money missions comes in.
What's the average size of your portfolios?
So from a complexity standpoint, because we cover and touch on all aspects of estate, trust, taxation, and then custom portfolio management, our typical asset minimum is $10 million in terms of liquidity. But so many of our clients are in illiquid states because they're building and eventually monetizing businesses. And it's just, it's such an incredible privilege. One of the things I love so much about what I do is just this handoff of trust, that people really hand you their life's work and you get to be a real participant in it. It's a wonderful part of the industry. I love it.
And it's an important role because, as we heard from Anne, and as all of us know who deal with life, you have to prepare your finances for the unexpected. I've been asking wealth managers, asset managers, if you've been hearing more from your clients lately because of all of these issues hitting the financial markets. And you actually said no. And that's because you already have a very proactive relationship with them. Explain that.
Thank you for that. Well, I started I do as a portfolio manager, that's essentially the handoff. And so we have a very proactive process on our team. We're meeting with clients quarterly. We do comprehensive financial plans and really anchor into what I call the highly skilled but transactional advisors, like the estate attorneys and the accountants that tend to sort of one-off in a person's life. But we're really bringing that kind of total picture to bear, and which is crucial. And you mentioned something just quickly. Our tagline is that we specialize in moments when life interrupts and disrupts, moments of change that change someone's sense of self, the people, their relationship to the people they love and care about, And while their bank account may change, the bigger change is happening in terms of their social setting, because typically these are people who become like the most wealthy person that they know, and it's a big struggle. And so we're very hands-on in that, and in that identity coaching, big part of it. You know, we kind of joke that like managing the money is almost the easy part. The volatility that we manage goes beyond just your traditional sort of arc of standard deviation, that efficient frontier that we're also used to seeing, and we actually overlay that with an additional volatility, which we call the volatility of life. And the more, you know, the older we get, actually life gets more disruptive. It doesn't actually get easier, and so that variable is the risk that we need to manage, because fear-based thinking is the biggest destroyer of returns. And so for us to do that, it requires, I think, a real big hug.
What is
a real big hug?
Which you are able to do, I know, from just knowing you this amount of time.
Yeah.
So that being said, you are proactive, you reach out to your clients, you have a close relationship with them, but what is the biggest concern that you're hearing now? And as we are discussing the different asset classes that hold promise, are you seeing certain trends that people are wanting to follow, or changes that they're wanting to make right now?
Yeah, thank you for that, because I think that within, you know, a market revolution, we're experiencing a mindset revolution in the clients that we're serving. And as wealth demographics shift in the United States, you're going to take on different cultures and relationships that people have to their money. And so I would say one of the biggest, I'm going to start with the shift that we're seeing, is when I started in the business in 1998, and I'll just share this, going through training programs, my manager at the time in a big room like this said, hey, the number one thing that you really don't want to do is you don't want to seek female clients because they're indecisive. And I thought to myself, well, I just made a decision. I don't think I'm ever going to listen to another word you have to say. And well, you know, here I am now.
Yeah.
So,
and what's your point now?
Yeah.
Share the percentage of female clients you had 20 years ago compared to now.
Yeah, and so it kind of, you know, because we work with a lot of CEOs and executives, and you would think that it would follow the thread, right, in terms of wealth demographics. So now, fast forward to today, 60% of our ultra high net worth clients are women. It's incredible. And
let me emphasize again, mostly first generation wealth builders, average $10 million.
Yeah, that's
wild.
promising. It's wonderful. And I actually have one of the only all-female teams. My two teammates are here in the back, Nicole and Brooke. And it's been an incredible thing, but we work with, you know, with men and women and couples. It's very interesting to see the conversations that are taking shape within those money relationships as people come together, and we work a lot with that too.
So since we're discussing this, I just have to ask you, do you see a difference generally, because I know we are all individuals, but how men and women are reacting to the volatility and to risk?
Yeah, great question. It kind of goes back to the second part of the last question, which is the trends that we're seeing. And so the way that I would describe this and the way we talk about it with our clients is that there are two ROIs. There's a return on investment, which is the science of investing, and then there's the return on impact, which is the point of investing. And so what we do within our practice is we build this sort of custom family index that addresses both. And having more women now, it's so interesting that comment from 1998, women bring a very thoughtful, diligent, impact-focused needs to the conversation. They think about their children, their grandkids, their husbands, their spouses. They tend to take on caretaking at the older generation, the younger generation, so the money becomes something very different, whereas our male clients are very focused on beating the index and competing with the index. And you know, the great news is that we're great portfolio managers. We can deliver on that too. And oftentimes I say I think that we actually save marriages because we can deliver on both, frankly, the ROIs. And that's a big thing. And I would just say one other thing, that I do think that the rise of the female investors coincides with ESG investing. There's, I think, a parallel from where I sit the last 20 years and the accessibility of the market through exchange-traded funds, portfolio processes, and then activating money towards a greater cause that is like building into that market mindset sort of ethos that, you know, frankly, money in the hands of women can change the world, and it will.
We are down to our last 3 minutes, and I want to ask you about the lessons learned again. That's a big theme of this breakfast. And you and your experience have seen similarities and lessons from the trends that you were dealing with early in your career, like the launch of the internet, globalization, to now. Everyone is trying to grasp AI and the impact that it will have on the economy and also globalization.
Yeah.
Can you talk about that?
Well, you know, the universal truths of good investing, they stand tall and strong in all market conditions if we just allow them to play out. And that takes a tremendous amount of patience, especially as markets become more inherently volatile just due to greater money supply and frankly deglobalization. And so when I started in the business in the 90s, everything was globalizing, right? It was long-term capital. We had, you know, the European Union, we had Hong Kong getting handed, all of these things were happening. And then the launch of the internet, which put humans at the center of self-autonomy. More information, I can make, you know, thoughtful decisions, I can point and purchase. And this wave of innovation, though, is looking to remove humans from the equation. Very different from an economics standpoint. This is the existential thing I think people are so concerned about. But in summary, the most important thing that I've delivered and I continue to believe in is that market investing is a long-term discipline, all right? And in our portfolios, we're constantly contextualizing them for the economic conditions that we're investing in, but we're using that like Nobel Prize winning modern portfolio theory, active rebalancing across size and style, sector weighting, security selection to deliver that alpha to clients on that risk-adjusted basis, which for individual investors is so crucial because it keeps them in their seat for the recovery. And I think that that's crucial going forward for people to understand that.
And for my final question, I always like to ask our panelists looking forward. And you're talking about the recoveries and making sure we generate and capture that alpha. My final question has to do with behavioral finance that you look at, and we were talking before about everyone knows investing should not be fear-based. So since you deal with clients, you interface with them closely, I want you to share your conversations with them now and about how you can prevent them from dislocating their financial returns in this time when there's uncertainty.
Yeah, thank you for that. You know, people are really, you know, they're worried. I mean, they feel it. Even if you can't put your finger on it, you know, it's like a vibe that's happening. And so for our clients, we want to separate out what we call political and policy volatility and even all the economic discourse, okay, from markets which are fundamentally inspirational, aspirational, and opportunistic. This is a very positive type of asset class. And so separating those two things out and understanding that while they coexist sort of in a parallel universe, they're operating in different time zones, right? Economists want to confirm what happened. They're very intellectual, fact-based. But the markets are opportunistic, always bending around the curve. And if you really think about it, things turn out better most of the time, more than people think. And so just having that mindset to know that we have to bend around the corner and we're entering into an incredible moment of innovation that will, in my personal opinion, make the internet look like, wow, like the fax machine at some point. And so anyways, very exciting to be here with all of you. And thank you, Janet, for being so brilliant and inviting me into this conversation.
Just sharing your thoughts. Sherry Paul, Managing Director of Morgan Stanley. Thank you so much.
Thank you. Thank you.
Now, please welcome to the stage Bloomberg Equities reporter Nora Melinda in conversation with David Kelly, Chief Global Strategist with JP Morgan Asset Management, and Kristen Olson, Alternative Capital Markets Group Global Head at Goldman Sachs.
Good morning, everyone. Thank you all so much for joining us. I'm sitting here with David Kelly and Kristen Olson. Super excited to talk to you all about positioning for a recession this morning. So we're going to go ahead and start out with David here. The market and the Fed are not agreeing. What is the market missing, and how does that factor into your own recession prediction?
Well, I think not a lot of people are agreeing with the Federal Reserve right now. I think that the Federal Reserve is trying to fight a battle that it's already won. Inflation is coming down. It just takes time to come down. Watching inflation come down is kind of like watching a slinky go down the stairs. It just has to come down at a certain slow pace. You could drop the slinky over the banisters and it gets there faster, but it's not a good way to do it. So what we're seeing in all the inflation numbers, all our modeling says that inflation is going to hit 2%, but it's going to hit 2% by the end of 2024. And that's what it's going to do. But with regard to recession, and I think that there are some technical issues in terms of the market thinking that the Fed has already said it's going to cut rates next year, and so partly that's priced in. There are some other technical issues which I think were affecting the futures market. But on a recession, I think there is still a risk of recession. We're still not there yet. I'm not going to call a recession yet. What we're seeing, we're definitely headed for slower growth. But when you look at the pieces of demand in the economy, look at housing, okay, it's come down a lot, but this is not 2008, and there's a big shortage of inventory, so that's not an issue. Consumer spending, yes, there's a drag on lower income consumers, but there's also pent-up demand for vehicles. That's helping out. Our biggest worry is about commercial real estate and regional banks, but even there, the loans, only 10% of the loans come due, basically, or the apartment leases have to be renewed, or the office leases have to be renewed every year. So it looks like a very slow-burning disaster. And so it could be that the other pressures in the economy ease by the time this commercial real estate thing really begins to press down the economy. So we know we're looking for slow growth. We may be one banana skin away from recession, but we're not there yet.
Got it. And so coming into this year, of course, a lot of investors were bracing for potential pain to come, but the economy has pretty much held up, and the market as well. Do you think that this is a rally that will hold up and continue?
Yes, I think I think it certainly has that potential. Let's first of all recognize there is such a thing as good news. We did have good news that it turns out that in Washington they're not completely crazy, and they did extend the debt limit out to 2025. Of course they should eliminate it, but at least we got that. And then the other piece of good news is that it turns out that Europe is very good at conserving energy. And so despite what Vladimir Putin's horrendous activity in Ukraine, it looks like both the Eurozone and the UK is going to continue to grow here, and China is coming back. So overall, the story has gotten better so far this year, and I think that is reflected in markets. But the most important thing is inflation's coming down, and a low inflation environment will ultimately mean a low interest rate environment, and that's what I think investors are banking on.
Thank you. And so bringing in Kristen, with the uncertainty going on right now, this obviously is a really good time for alternative asset management. Can you please talk about what the questions that your clients are asking you and what you all are focusing on in this time period?
Sure. So I guess the first thing I would say in the world of alternatives is we tell people to stay the course, have a strategic plan, and sort of put the blinders on to everything that's going on in and around in the broader macro environment and all these various risks. And part of that is just the nuances of how do you build a strategic alternative investments portfolio. It takes a lot of time. You need to do it year in and year out, and you need to be consistent, which means you can't let the various risks that are swirling affect your plan at the strategic level. And I think that's what we're seeing. And so we're coming off of record commitment flows and allocations from our ultra high net worth investors, 2021, 2022, actually record commitments. And we're on pace to, we'll see how the year ends, but we're on pace to potentially meet that again this year, which just shows you that clients are staying the course in terms of trying to get to that target. And for us, our strategy would have a moderate client with almost a 25% allocation to alternatives. And so it's hard to get to that target, and you really do have to stay consistent. But then what I would say is below the surface, of course, you're looking at what's happening in the environment. And what that means is you see pivots in terms of which strategies within alternatives. So I think on the buyout and core private equity side, clients remain consistent and persistent. They've seen alpha generation over the last 25 years in that space of median managers doing 300 to 500 basis points better than public equity markets. So they appreciate the alpha that can be generated. But where you see pivots are in this market, secondaries, right? There are liquidity constraints. Institutions are faced with the denominator effect. And there's the opportunity to step in and get attractive discounts into private equity through secondaries. The other area within alternatives right now, private credit. Very hard to shy away from an opportunity where you can be top of the capital structure, senior direct lending, and get returns that are unlevered double-digit yields and total returns that are not that far off of what you're seeing in private equity. So I think private credit is certainly having its moment. And I think if people are concerned that we do trip into a recession, they'll take the other side of the credit bet and look for managers that are more special situations, distressed oriented, to take advantage of particular cracks in the economy or in the credit cycle. So I think those would be kind of the areas that we're seeing right now.
And so I know in regards to portfolio management, a lot of people have been talking about the demise of the 60-40 split. Do you think that is overplayed, or do you think there's some truth to that?
Well, I think, first of all, the first issue is that last year we had a very bad year overall for 60-40 portfolio. Equities were down, 60-40 portfolio overall was down about 16%, but it was the first year since 1974 where a down year for equities was actually made worse by a down year for bonds. That's the first time in 48 years. And it's kind of like the cicada bug. I mean, it shows up once every 17 years, so okay, you enjoy it, but then you don't let that dominate your thinking. What happened last year was inflation is kryptonite to both stocks and bonds. So when inflation finally became the story for the first time in 40 years, that's what hurt both stocks and bonds. That's why you got that nasty correlation where both bonds and stocks are going down at the same time. Actually, so far this year, as the inflation story fades, you're getting that effect again, only on the positive side, with both stocks and bonds, I think, having a good year. But our firm belief is that, when we get off this, think about roller coasters, you actually get off where you get on. No matter how bumpy the ride is, we think we're getting off at 2% inflation. If that's right, if the middle of this decade actually looks remarkably like the middle of the last decade, low inflation, low interest rates, then the real question is going to be about real growth again. And in that environment, that negative correlation, that zig when the other side zags, that's going to be reestablished. So from that perspective, I think the 60-40 portfolio is not dead. Of course, we'd both agree that it's not just 60-40. It is you need a rainbow of different assets in that portfolio to get true diversification.
And talking about that rainbow, I really appreciate chatting with you all. This has been a wonderful conversation. We do have to wrap. But I just wanted to thank both David and Kristen for joining us this morning. And thank you to all of you all for coming out this morning and for attending. A very big thank you to our sponsor, Allspring Global Investments. Please make your way downstairs to the 7th floor as Bloomberg Invest New York continues with Stan Druckenmiller.
This will be the one I've waited for. This will be the first time anyone has loved me.
David, I'm so sorry I had to cut you both short.